Good morning and welcome to Managerial Accounting. As we look at our calendar, you can see that we finished up chapter 19 last week, so the chapter 19 problem should be submitted for grading by the end of the day today. And then we'll be covering chapter 20 this week. So chapter 20 pre-quiz should be submitted by the end of the day today. Chapter 20 exercises on Thursday. You'll notice I've added this group session on Friday. That's an optional review session where we can spend time working on chapter 20 or whatever else you need to work on. Later today, there will be a link in Starfish for you to sign up for that group session if you want to participate. I'm willing to be flexible about those times. So this week I scheduled it for Friday morning. Generally Friday morning or Monday afternoon might be good for the next, as you can see, the next several weeks. We're on that same schedule, maybe for the rest of the semester, where we spend Tuesday, Thursday covering a chapter, and then the problem is due the following Tuesday. So we can play that by ear. If there are people who want to attend, you can just let me know if there's a time that works better for your schedule. Other than random meetings and things, my schedule is pretty free other than this time that we have class Monday through Thursday. So you can also see that 1 week from today, the research part of your project is due. We already talked about that in an earlier class. If you have questions about what you're supposed to be doing there, just let me know. But in a nutshell, it's 3 sources. One is the company, 2 other sources, brief couple sentences about each source, how it's going to be useful in doing your project. Any questions about anything at this point? Anything at all? Up to and including chapter 19. If not, we'll just get started with our chapter 20. Beginning. This is probably my favorite chapter, and I don't know. I feel like it's like your children. You're not supposed to pick favorites, you know. Probably shouldn't pick favorites, but for this class, for managerial accounting, this is probably my favorite chapter. And I think the reason it's my favorite is because it seems so readily useful in making business decisions. So our whole focus this semester is on the internal decision making or management decision making, and how we as accountants can provide information to decision makers within our company to help guide the operations of that company. And so cost, volume, profit, or CVP analysis is one of the very effective ways of providing that information to a business to help them make appropriate decisions about their company. As always, we have a series of learning objectives, and we'll be working through these learning objectives in this chapter. So the exercises that we do are all related to these learning objectives. We will start out talking about what it means to be a fixed or variable cost. That will be somewhat review from chapter 15. We will talk about a new way of looking at the income statement called contribution margin. So in chapter 4 in financial accounting, chapter 5 in financial accounting, we introduced the idea of profit margin or gross margin. And those are not the same thing, but we learned about gross margin, or what this textbook tends to call gross profit. Well, contribution margin is just a different way of looking at the income statement, dividing up our expenses based not on product versus period, but based on fixed versus variable. We'll talk about how we can use that relationship to determine the break-even point. That is, how many units of a product does a company need to sell to break even, to exactly cover their costs, no profit but no loss, and how much we would need to sell in order to reach some targeted amount of profit. You can see here a reference to using a profit volume chart. We won't really be using that, mostly because graphing becomes more challenging in the online environment. I don't think I could draw a graph terribly well on the screen, but also not everyone works from the visual angle, and so we'll be looking at more the concept rather than the charting of it. Very end of the chapter, we'll be talking about operating leverage, margin of safety. We'll also look at a scenario where companies make more than one product. How do we use this same CVP analysis within those constraints? So as I said, we're going to be starting with a review of this concept of fixed versus variable cost that we introduced back in chapter 15. We talked about in chapter 15 classifying costs along a number of dimensions. We talked about product versus period cost. We talked about value adding versus non-value adding. And the one that we introduced at that time, but I said would be relevant later on, that would be now in chapter 20, is whether a cost is fixed or variable, which is the cost behavior. And I can remember saying, it's funny to talk about costs behaving in a certain way as if they have thoughts and opinions and whatever. But they really do. So if we divide them generally into two categories, fixed versus variable, but there are some costs that have features of both, and we call that a mixed cost. So it's partly fixed and it's partly variable. As we're looking at variable costs in particular, we're interested in identifying what makes that cost change. And we've heard this term before, the concept of an activity driver or an activity base. So whenever we're talking about a variable cost, we want to identify or determine what is it that makes that cost vary or change. The other concept that you can see on this screen is the concept of a relevant range. So when we talk about a cost being fixed, we mean that it stays the same all the time, regardless of our level of activity. So we might make more units, we might make fewer units, but that fixed cost is assumed to remain constant or remain the same in total. Where a variable cost, if we produce more or if we experience more of that activity base, if that level goes up, if the amount of that driver goes up, we would expect a variable cost to go up. And if the amount of that driver goes down, we would expect a variable cost to go down in total. It's important to recognize, though, that a fixed cost may be fixed within some certain range, but it's probably not going to be fixed no matter how much we produce. So the more narrowly we can define our relevant range, the more accurate we're going to be with our understanding of the cost behavior. So let me give you an example. If we say that, let's see, a normal fixed cost would be maybe rent or insurance on the building where we're operating. And so the rent and the insurance would be based on the value of the property, not how much we use it to produce. So if you agree to pay, just say, $1,000 a month in rent to use a store, if your store is busier, you're still going to pay that $1,000 in rent. If the store is closed for a week because you're going on vacation, you still have to pay that same amount of rent. That's a classic example of a fixed cost. However, if your store is expanding and you need more space because your sales are going up. You need more space. You're probably going to have to pay more rent because you're going to move into maybe that space next door or add on or something like that. And by the same token, insurance on a property, although it's based on the value of the property, if you have a significant amount, increase in the inventory that you're carrying, the insurance on that inventory is going to go up. So when we talk about a fixed cost, it's important to keep in mind fixed within some certain band of production. So when we're making these decisions about how much to produce, we are not usually deciding, do we produce 0 or 50 million? There's some band of, well, we might produce 10,000, we might produce 12,000. I don't know exactly how much it's going to be, but it's in this relevant operating range. And that's the important, one of the important things to keep in mind with our fixed costs. They're fixed in a certain band. And if our band changes significantly, if we're going to triple our production, we thought we were going to make between 10 and 12,000 units. Turns out we're making 30,000. The assumptions we've made about those fixed costs are probably not going to hold nearly as robustly. So again, back to that concept of cost behavior, all of our costs can in general be divided between be assigned your fixed cost, your variable cost, but there are some costs that we classify as mixed costs. One of the most common examples of a mixed cost is utilities. So there's going to be a base cost just for keeping things running. Think about, if you go on vacation, there's still going to be a certain amount of electricity used in your home because there are that baseline, the refrigerator's still running, you probably didn't unplug the freezer because you left for a week. So that baseline need of electricity is the fixed part. Regardless of what you do, whether you have the Christmas lights plugged in or not, you're going to have a certain base usage of electricity. The variable part then is how much you use on top of that. So the fixed cost, even if we go on vacation for the month, we would expect to still be paying that certain amount. And the variable cost is the extra that you pay because the month of December you have your Christmas lights plugged in and the electric bill goes up. Does that make sense? It used to be telephone usage was probably the most common example for a mixed cost. I don't know if anyone has phone plans like that anymore, but it used to be, when there were no cell phones, way back when, that you had your home phone line and you paid a certain fee just to have the phone, and then you paid on top of that by the minute for any long distance calls, and there was long distance and local regional long distance, and those were different rates. Some people may have had a plan that you actually paid by the call for local calls. If you didn't use a lot of phone service, then you might have taken a very inexpensive plan, just like some people might have on your cell phones now. Even when cell phones came out, and again, this is probably before you guys would remember, but when cell phones first came out, there was long distance on cell phones and there was roaming charges. So you had to be careful when you were near the Pennsylvania border because your cell phone might click over to a Pennsylvania tower and then you get hit with roaming charges. I say this from experience. I remember it happening where my bill showed roaming charges. We were, and then looking at where it was, I'm like, we were in New York, but it picked up a Pennsylvania tower. And so it was charging roaming charges. So
You use data as an example for it too.
Okay, so yeah,
Especially cell phone data, or sometimes depending on who you go for internet service and stuff, you get the base rate at whatever.
okay, yeah, so
many gigs a month.
okay, yeah, and I guess I'm just truly didn't know if people actually had plans like that still. I didn't know that there were plans that weren't considered unlimited, unless you had like a, what are they called? Track phone kind of thing, where you just have the monthly contract. So, yeah, good. So if you're
I
familiar
mean, I
with
know
that,
they've mostly switched over.
so if you're familiar with, you may be familiar with that concept through cell phones as well, that you may have a base amount of data that you can use. That would be the fixed cost. And then if you exceed that amount each month, then you're paying the extra data charges. So that definitely would be an example of what we're talking about here. So in order to use this information to help us make business decisions, we need to be able to accurately determine or separate of all of our costs, which ones are variable, which ones are fixed, and which ones are mixed. And for those costs that are mixed, that do have components of each, we need to be able to, in a real way, separate them so that we can do calculations based on, okay, these costs, fixed costs, aren't going to change regardless of what we do. But the variable costs, if we produce more, those are going to go up. If we produce fewer, these costs are going to go down. If we are not able to accurately determine which costs are fixed and variable, and to separate the mixed costs, if we are incorrect in what we believe to be fixed versus variable, we will, the less accurate we are with that, the less reliable the results of our CVP, cost volume profit analysis, will be. Talked about this already. Just a reminder, and again, some of you I know probably are more visual like this, that looking at the graphs makes things click for you, so I will go through those. For a variable cost, we will assume that within our relevant operating range, the variable cost is fixed, is the same per unit. I don't want to use that word fixed, is the same per unit. And so we can see in this right-hand graph that regardless of how many units we produce within our relevant operating range, from 0 to 30,000 units, the variable cost per unit would be $10 per unit, constant, horizontal line, slope of 0, okay? If that's true, if it's $10 per unit, that means if we make 0 units, the cost is 0. If we make 10,000, the cost is 100,000. If we make 20,000, the cost is 200,000, and so on. It is a straight line, and the slope of that line is the per unit variable cost. In this case, $10 per unit would be the slope of that line, okay? Some examples of variable costs for JCC. Instructor salaries might be a variable cost. Now that is not true for full-time faculty, because I am salaried, so I have a contract to have X number of credit hours. But for part-time or adjunct faculty, that would definitely be the case. They get paid by the class, and so the more classes they teach, the higher that cost is going to go. For airlines, fuel is a variable cost, and the number of miles flown is a good way of estimating how much that cost would be. As we think about the product costs that we've been talking about since chapter 15, direct materials, direct labor, and overhead, of those, direct materials and direct labor are variable costs. The more we produce, the higher those costs are going to go in total. But the per unit cost is basically the same, regardless of how many units we make. If you're making bicycles, every bicycle is going to get 2 tires, right? Every bicycle is going to get 1 set of handlebars, 1 set of brakes, and whatever. So, and if you're thinking, well, no, they have 2 sets of brakes, that's fine. You get the idea. The point of the relevant range, using that bicycle as an example, if we're making just 500 bikes because we're kind of a boutique kind of custom order bicycle manufacturer. We're probably paying a certain amount for those tires. If we bump up our production and we're making 10,000 tires, or excuse me, 10,000 bicycles rather than 500, we're probably going to get some kind of bulk discount price break. And so the cost of our direct materials at that point is probably going to be lower per bicycle than if we only make 500. And so we need to keep in mind, again, that concept of relevant operating range. We need to have a pretty good handle on approximately how many units we expect to make. We've talked about what fixed costs are. So if you think about fixed costs, you'll notice these graphs look very similar, but in reverse order. The total fixed cost is constant regardless of our level of activity. So using those same concepts, the x-axis is the number of units or the level of activity, the amount of that cost driver. And the y-axis, the vertical axis, is the dollar amount. Okay, so if you've taken economics, you should already be familiar with that format or that style of graph where we have units on the x-axis. If you've taken statistics or are taking statistics, the x-axis is used for the independent variable and the y-axis is used for the dependent variable. That is also relevant here, that concept of independent versus dependent variable. We assume that the number of units produced is driving the cost. If you haven't taken economics, if you haven't taken statistics, don't worry about it. If you're thinking, I don't even know what she's talking about, that's really okay, because we're going to keep contextualizing it and making it relevant for accounting. As I already explained, I'm not going to ask you to draw graphs like this, but for some people, I know it's going to help you understand the concept. So, fixed cost, fixed in total, regardless of how much we produce. But because of that, the more we produce, the lower the per unit cost goes. So back to that example that I said, we're paying $1,000 rent in our store. If we have 2 sales a month, that's $500 in rent per sale. But if we have 1,000 sales, that's $1 per month per sale, or $1 per sale in that month. And so for our fixed costs, the more we produce, the more likely it is that we would be producing at a profit, because our cost structure is going to change. And so again, we'll be able to use that relationship in the CVP analysis to see what would happen if we made more units, or what happens if we only sell, we sell fewer number of units. So one last time, maybe. Variable costs, we assume vary in total, but fixed costs remain constant in total. So when we talk about the per unit cost, variable cost is the same for every unit, direct materials, direct labor. Fixed costs come down per unit if we produce more, or if our level of activity increases. And here are some examples. Depreciation under straight line is a fixed cost. And I should say up front, by fixed cost, we could even say that an accelerated method like double declining balance depreciation, you could also say is a fixed cost, because we know what it's going to be in advance. It may not be the same as it was last year, but we know in advance what it's going to be, and it's not dependent on how much we use or how much we produce. So the fact that they've called out here straight line depreciation is a little bit misleading. It's not the only one of the 3 methods that we talked about in Chapter 9 in financial accounting. the only one that is a variable cost would be the production method or units of production method. Because if we use it more, we record more depreciation. That is a variable cost. So for a fixed cost, it's not necessary that it's exactly the same as it was last year or in a prior period, but that we know in advance how much it's going to be for this period. Salaries are also probably not the same from year to year, right? People probably get raises or merit increases, cost of living adjustments. So insurance is probably not the same as last year. Taxes are probably not the same as last year. But the key piece is we know how much it is in advance, and or that it's not dependent on our number of patients or our number of guests or the number of units produced. It's a constant value in that it doesn't change when our activity base changes. That's enough of me talking for the moment. Does anyone have any questions at this point before we go look at our first exercise? Feel like you're comfortable with what is a fixed versus a variable cost and what it would mean to be a mixed cost? Okay. Let's go to our, oops, if I can get there, let's go to our exercises then. And we'll look at exercise 1. I'm not going to do the whole thing with you. We're not going to go line by line, but we'll do a few of these together. This is, as you can see, one of those multiple choice type questions where you've got a 33% chance of getting it right just by strictly guessing. I don't think it's helpful for us to spend class time going over every one of these. We'll do a few together. I'll ask you to do the rest on your own outside of class. And then, of course, if you have questions about them, you can certainly ask. So I'm just going to jump around. Let's look at number 4, the salary of the plant manager. Would you say that's fixed, variable, or a mixed cost? The salary. It is a fixed cost. How about metal? Now it doesn't, what is this for? Following is a list of various costs incurred in producing replacement automobile parts. So for number 8, where it says metal, what they're talking about there is a direct material for making these parts. So would that be fixed, variable, or a mixed cost?
Is it a variable?
It is a variable. Thank you, Simon. It is a variable cost. So any direct material, the more units we make, the higher those costs are going to go. Let's look at number 10. This is an interesting one. So number 10 says the property insurance premiums are $3,600 a month plus 1 cent for each dollar of property over 1.2 million. So it's 3,600 flat rate plus some premium based on the value of the property. So what would that be? It is a mixed cost. So to separate them, they actually already have it separated for us. $3,600 is the fixed part. And then we can calculate the variable part based on the dollar of property over 1.2 million. How about electricity costs down here, number 13? They tell us that it's 20 cents per kilowatt hour.
Variable.
So that would be a variable cost. As I already said, we normally think of electricity as being a fixed cost, but they have removed that fixed. We think of electricity as including a fixed cost, that base level that's needed to keep the lights on in the building, basically, keep the refrigerator running in your home while you're on vacation. even while you're not using it. But based on what they have described here, that they've given us a rate per activity base, per kilowatt hour, we can say that's variable. We will normally look at utilities as being a mixed cost. Okay, so I think everybody is probably okay with the rest of these. Any questions about what we're doing there? Okay, I assume everybody's comfortable with finishing that up on your own. Let's move ahead then to exercise 2. And again, we're going to do a couple of these and then I'll ask you to complete the rest on your own. For a major university, select the activity base most appropriate for each cost listed below. An activity base may be used more than once or not used at all. So if we're identifying an activity base, we are recognizing that that these costs may change, and the activity base is a reasonable driver to understand where those costs are coming from. So let's start with the first one, financial aid office salaries. Now, we already said that in general, within our relevant operating range, our salaries are going to be considered a fixed cost. But as we look at what's driving them, of these, what do you think might be a relevant activity base? I wouldn't include all of the students because not all students apply for financial aid. And we may have students who apply for financial aid, or potential students, I should say, who apply for financial aid, but then do not end up coming to JCC or this major university because they're applying at a number of different schools and getting financial aid packages from all of those schools. And so I think the number of applications rather than the number of students, or even the number of students receiving financial aid, because that ignores the students who apply. The financial aid office has to work through those applications, and then some of those students do not end up attending the school. How about housing, personnel, wages? Now, we do normally think of wages as being a variable cost. Do we want to include everyone who enrolls? Do we want to include student credit hours? Do you think it takes more housing personnel time to manage students who have higher or lower credit hours? I would say that's probably not true. So the most appropriate activity base would be the number of students who are living in that housing. Make sense? Everyone feel okay with these? I'll ask you to do the rest of those on your own, and we will keep going. Exercise 3 then brings up relevant range, fixed and variable costs, and is going to, get my calculator here, it's going to help us to see how fixed costs behave compared to how variable costs behave as our level of activity changes. So this top line gives us a fairly wide operating range from 40 to 120,000. As I suggested, we generally want to keep our relevant operating range as narrow as possible because it gives us more confidence that our analysis is robust, that it will stand up to changes. So this exercise says Child Play Incorporated manufactures electronic toys within a relevant range of 20 to 150,000 toys per year. That is a huge range. And I would suggest that some of the costs that they're identifying as fixed costs, we really need to be careful that those costs may not be the same at 20,000 as they are at 150,000. So narrowing that range would probably be a beneficial task to undertake. But let's go ahead and look at what we have here. So if the fixed costs are 600,000, I'm starting with the fixed costs in the total. So we have the top part of this chart is for total cost, the bottom part is cost per unit. So the total fixed cost is the easiest place for us to start. If it's 600,000 at 40,000 units, it's 600,000 at 80,000 units and 600,000 at 120,000 units. Again, I said I'm not convinced that that's necessarily true, but we have to use what we are given. So let's go down to the bottom portion and calculate our fixed cost per unit. Spreading that 600,000 over 40,000 units, $600,000 divided by 40,000 units would be $15 per unit. And it asks us to compute the cost per unit to 2 decimal places, so out to the cents place. If we take those same 600,000 in fixed costs and spread them over 80,000 units, twice as many units, it's going to be half the price per unit. And if we take that same 600,000 and spread it over 120,000 units, 3 times the 40,000, it's going to be just 1/3 of the price. And so you can already see that reduction in the cost per unit. The more units that we produce, the more units we can spread those fixed costs over more units, the better off we will be in terms of our profitability. But our variable cost per unit, remember that graph, the variable cost per unit is considered to be the same, regardless of how many units we produce within our relevant range. So our variable cost per unit would, let's calculate that with what we're given. $720,000 in variable cost spread over 40,000 units would be $18 per unit. Everyone see where that came from? With that horizontal graph that we saw, we know that it's going to be $18 per unit within our relevant operating range, regardless of how many units we produce. So I can fill in that line all the way across.
Cindy, can you tell me again how you got the variable cost per unit? You did.
Yep, I'll put it right on the screen. So the normal abbreviation for variable cost is VC. So VC per unit, we take our total, we take our total variable cost, which is given at $720,000 in the top part of the chart, and we divide by the 40,000 units.
Thank you.
Yep, makes sense. And so that is constant per unit, that horizontal line we saw in the graph. So $18 per unit. Oops. If it's $18 per unit and we make 80,000 units, the total is going to go up. We made twice as many units, our variable cost will be twice as much. If we make 120,000 units, that's 3 times as many units as the 40,000. Our variable costs are going to be 3 times as much. And so when we come down to the bottom, putting in our totals, you can see that the total cost per unit is also coming down as we make more units. The variable cost per unit remains the same, but because that fixed cost per unit is coming down, our total cost per unit is also coming down. That has implications for us as we get into the CVP analysis and the concept of contribution margin that we'll get into next. Is there any question about what we've covered here? Let me go back to our PowerPoint just for a minute, and we'll come back to the exercises. So as I said, for our analysis, we really need to be able to identify accurately of our costs, what is fixed and what is variable. And if we have a cost that is a mixed cost, we need to be able to separate that. There are into its fixed and variable pieces. And that's what you're seeing on this screen. So we have a fixed cost, if we have a mixed cost, we need to be able to separate it into its fixed and variable components in order to accurately do the analysis that we're going to be covering later in the chapter. There are several different ways we can do that. If there are people who have taken or are currently taking statistics, one way to do that is by using a linear regression model. So if you have a bunch of data from previous months or from your history, you can plot those onto a scatter plot. Does everyone know what a scatter plot looks like? Okay, people in the classroom are nodding. Obviously, I can't see you guys on Zoom, but a scatter plot, XY coordinate, put the dots on the chart them on the XY coordinate pair, and we can see if it appears that there's a straight line relationship. We can use linear regression without doing that scatter plot to come up with the best fit line, and then an estimate of how valid or how accurate that line will be by measuring the error term. So again, we're not doing that in this class. This is not statistics class. We are not doing linear regression, but linear regression is probably a much more reliable method than what we're going to be doing, because it takes into account all of the data points. We are going to be using a much simpler version that relies on basic algebra rather than on statistical analysis, such as linear regression. So our analysis is going to actually use the slope-intercept form of the line. Does that sound familiar? I think that's geometry maybe, right? Slope-intercept form.
Yeah.
Okay. So we're going to be using the slope-intercept form of the line, and if you are not familiar, if you don't remember that, don't worry. I'm going to walk you through it. If you are familiar with slope-intercept, it will help you to better recognize what it is we're doing. But even if you don't remember slope-intercept form of the line, you will still be able to do this technique. It will just, I think, make more sense about what we're actually doing if you can think of it in the context of we're finding the formula for a line in slope-intercept form. So let me spend a few minutes just describing what that is. And I know I said a few minutes ago that I don't think I can draw a graph on Zoom, but I'm going to try here. Okay. So here's our XY coordinate pair. And I had suggested, let's see, use the X here. So I had suggested that what we do is put together a scatter plot, which would look something like this. And the scatter plot would be all of the XY coordinate pairs, all of the data that we have from the previous months maybe. So I put how many? I put 8 dots, 8 points on this scatter plot. Let's pretend that those are 8 separate months worth of data. And as I already pointed out to you, the format is units on the x-axis and cost on the y-axis. So we're trying to use units, the level of the activity driver, to predict what the cost will be. So before we use a high-low method, it is appropriate to take our data and put them onto a scatter plot like this and see if it looks like there is a straight line or a linear relationship. And it looks to me like there is. If I were to draw a line through these points to find the best fit line, I would say it might be something like that. Right? Everyone see that? Make sense? Okay. Linear regression would take all of those 8 points that we use, that we have available to us, all of the data, all of the historical data, and it would find the equation of that line that reduces the error. The error is how far away are these points? Change my color here. So this would be the error. How far away are these points from the line? So we came up with this line and we want to know how accurate is it? How close are the actual points to the line that we came up with? It's a pretty good tool for finding when there is a linear relationship, a straight line relationship like this. It's a pretty good tool to help us with that. But as I said, we're not going to be doing that. What we are going to do instead is choose the highest value. I think I'll use a heart here. Valentine's Day just passed. The high-low method means we take the highest point and the lowest point. Actually, that right there is probably the highest point. Can't really tell on my graph because I was just randomly putting numbers on or putting points on there. It's only 2 points. Ignore this part right there. High-low method would take these 2 points, find the line that connects those 2 points. It might look, I just put another line on here. So the line that connects those 2 points might look more like this. So it may not be the perfect or the best fit line that that linear regression model would give us. But the high-low method does give us a way of creating a line and then assuming that the line is a way of estimating or predicting what our cost would be at any point along this line, at any number of units. We mentioned that concept of relevant range again. Within our data set here, we only have data that goes from about here, where it crosses the X, to here. And so when we find this equation using the high-low method, when we find this equation for that blue line on my graph, it really would be inappropriate for us to use that equation to predict what the cost would be if our units were, say, up here or down here, because we don't have any data at those points. It's okay to use it for anything between here, between these 2 points, but we really need to be careful about using it to predict what would happen above the highest point or below the lowest point, because we don't know. We don't have any data. We don't know that this straight line relationship that seems to be here continues beyond the boundaries of our relevant range. So again, that's the importance of narrowly defining our relevant range if we can, so that we are more certain about our results. Okay, I know we haven't done anything yet with the high-low method, but does everyone feel okay with what I'm describing here? That we're going, from our data set, we're going to choose the highest and the lowest point and find the line that connects those 2 points. I said we're going to use the slope-intercept form of the line. So the intercept, as a reminder, the y-intercept would be this number right here. If x is 0, if we produce no units, what would our cost be? That's the interpretation of the y-intercept. It's the fixed cost. The y-intercept is the fixed cost. If we produce 0 units, our cost would be whatever that number is right there. And then the slope, I already told you, but I will repeat. The slope of this line is the cost per unit, and that is the variable cost. So the slope-intercept form of the line is, for those of you who may not remember, y equals mx plus b. That is the generic form, slope-intercept form of the line. We just described that this will be where y is the cost, I should say total cost. X is the level of the activity driver or the cost basis, number of units of whatever it is we're measuring. M is the variable cost per unit. And B, the y-intercept, is the fixed cost. So what we're going to be doing next is going to our next exercise, which I think is exercise 4. Yep. And we're going to be using what we just described here from the information that's given in exercise 4. We're going to be using this approach, the slope-intercept form of the line, y equals mx plus b, to find our variable cost per unit and our total fixed cost. And then we have our predictive equation that for any level of the activity, for any x, we can predict what y would be using that equation. And before I clear this and go to our exercise 4, does anyone have any questions? As I said, if geometry is not your thing, it's okay. You'll still be able to do this, but I think it will help you to understand better what we are doing. I never even check my work there. It will help you to understand it better if you can relate it to that slope-intercept form of the line. Exercise 4 says Ziegler Incorporated has decided to use the high-low method to estimate the total cost and the fixed and variable cost components of the total cost. The data for various levels of production are as follows. And so we're using units produced as our cost driver or activity base. And we are assuming that we can come up with a formula, an equation, that we can predict what our total cost would be if we produce some number of units. The range of our data goes from 80 to 120,000 units produced. And so that's our relevant operating range. We would not want to use whatever equation we come up with. We would not want to use that equation to predict what if we made 150,000 or 247,000. The farther we stray from that 80 to 120,000 operating range, the less likely it is that our equation is still valid. We refer to that as how robust our analysis is. How much is it going to stand up to changes in our assumptions? So from these data, we can identify the low point and the high point, right? Oops. We can identify the high and the low point. Well, we'll start out by calculating the slope. Does anyone remember the formula for slope? How do we find the slope between 2 points?
I'm not supposed to be.
Yep. So what you just gave me, Drew, was the equation for the line. So and yes, we will be using that. So yep, that's another way of describing it. So Maddie said in the chat, change in y over change in x, or rise over run. Does not matter which point you choose as point 1 and point 2. I'm going to use the high point first and then subtract the low point, because then I'll end up with a positive. If you use the low point and subtract the high point, you'll just end up with a negative divided by a negative. You'll get the same answer. It does not matter which way you do it. The formula, rise over run, or change in y over change in x, usually you would do these as subscripts, but I am not that sophisticated in Zoom. I'm not sure if that's even an option. So it does not matter which point you assign to be point 2 and which point you decide to be point 1, as long as you're consistent. So I'm going to call our low point, point 1. I'm going to call that point 1. And the high point I'm going to call point 2. If you think about the graph that I had drawn on the screen and the way I explained it, the y-axis, which is the vertical axis, is the dollar amount. That's the dependent variable. And so the total cost is going to be our y. And the unit produced is our independent variable. We think we can use the units produced to predict our total cost. And so now I can go about plugging into this formula, because I know which point is what, total cost is y, and the units is the x. So y2, total cost for point 2, would be 32,120,000. Everyone see that? So it's y from point 2. And then we subtract from that the y from point 1, 25,100,000. We divide that quantity by, I'm going to have to move this over just a little bit to give myself enough room, by the x, the units produced from point 2, 120,000, minus the units produced in point 1, 80,000. Is everyone okay with that formula? See where it's coming from? Because we've labeled the x and the y, the 1 and the 2. So now it's just a matter of solving. Charge my calculator. Very proud of myself. Remember to bring it to work with me. And so the denominator is 7,020,000. That's the change in our total cost. From 80,000 units produced to 120,000 units produced, our total cost went up by $7,020,000. And that was a change of 40,000 units. Which equals $175.50 per unit. So the slope of our line is 175.5. Remember, we said that the slope, the M, is our variable cost per unit, which is the answer to the first question. The slope of our line, the variable cost per unit, as we increased our production, the cost, total cost went up by $175.50 for each additional unit we produced. Does that make sense so far? Anyone with questions? Okay. So we know our general formula here a little bit, is y equals mx plus b. That is the slope-intercept form of the line. But we now know what the m is, and so I'm going to plug that in, 175.5. I put the 0 automatically because it's cents. So 175.5. It's okay if you want to put the dollar sign there. Doesn't matter. So here's our equation. Y equals 175.5 times x plus b. The interpretation, the understanding of this is our total cost, y, will be $175.50 times the number of units we produced. For every unit we produce, we add $175.50 per unit. Plus, the B is that fixed cost, so the y-intercept. Even if we produce 0 units, we're going to have some cost. That's the fixed cost. From this point, I have 3 variables. I cannot solve an equation in 3 variables. I need it to be just 1. Well, we have 2 separate points that we're using here, point 1 and point 2. It does not matter which one you use, you will get the same answer either way. So, as I've said before, it's not that I'm lazy, but I try to be efficient. I try to do it the easiest way I can and still get the best answer possible. So I'm going to use point 1 just because the numbers are smaller. You could just as well use point 2, but I'm going to use point 1. I'm going to plug point 1 into this equation. The y from point 1, the total cost from point 1, our low point, was $25,100,000. Equals the m, the slope, the variable cost per unit, 175.5 times the number of units from point 1, which is 80,000, plus b, that y-intercept. And now we can solve. I want to simplify first. We take that 175.5 and multiply by 80,000 units. Oops. Put the comma in the wrong place. I'm sure that there's a way, I just have to do something about it, to make this calculator stick commas in there. Right now it has no commas, so I have to count the zeros and figure it out. Okay. Everybody good so far? Okay. Yeah. We could have used the higher one. I chose the lower one because the numbers are smaller, so it makes it easier. But you'd get exactly the same answer whether you use the high numbers or the low numbers. Because remember, what we're doing is taking those 2 dots and connecting them. So both dots are going to be on the line. What you would not want to do, though, is use this middle point, because the middle point may not be exactly on the line. Remember that diagram, the scatter plot I had drawn, all the dots were not on the line when I put a line connecting the top and the bottom points. The points didn't all just fall right in the line, right? It may be that this number is exactly on the line, but that's not very imaginative, creative exercise making. But, yeah. Let's solve for b then. We want to get B by itself, so we're going to subtract that constant 14,040,000 from each side to get B by itself. And I got $11,060,000. What is that B? It's our fixed cost. And so now we can put that into our answer box here. Is everyone okay with where that B calculation came from? But now we have our formula. Y equals mx plus b. I'm just going to start plugging into this. So we know that the y is the total cost. We know that the m is the variable cost per unit. We know that what the x is units produced. Whoops. Let's have some more room here. Units produced. And now we know that the B is $11,060,000. That is our fixed cost. So here is our formula that we can use to predict within our relevant range between 80 and 120,000 units, between 80 and 120,000 units, we can plug in any number of units between 80 and 120 right here into this formula to predict what our total cost will be in the month that we produce that many units. And that's what we're asked to do in part B is, well, what if we produce 115,000 units? So we're just going to plug in here 115,000. For units produced and see what we get. 115,000 times 175.5. Each of those 115,000 units adds $175.50 to our total cost, plus the $11,060,000 in fixed costs that we'll have even if we produce no units. Our high-low method, the formula that we got, says that if we produce 115,000 units, our total cost would be $31,242,500 units. That is the high-low method. If we have a set of data, we can choose the high point and the low point, find the slope between the two. That's the variable cost per unit. Then, using the formula y equals mx plus b, we can choose either point, plug into that formula to find our y-intercept, which is the fixed cost. We then have a formula that we can use within our relevant range to predict what our total cost would be at some level of activity. In this case, units produced. It's perfectly acceptable to use this formula between 80 and 120,000 units. Going outside of that makes it a little suspect. You know, the farther we get from that, you know, using it for 78,000 units is probably fine. Using it for 270,000 units, probably not fine. It may be, but we just don't have any data. We don't have any evidence that this straight line relationship continues beyond these 2 points. It might taper off. It might start going up, you know, in a much steeper slope with no evidence. And so the farther we get outside that range, the less likely it is that our relationship, our equation holds true.
Well, even then, if this is a scatter plot, we don't know that 92 is directly on the line.
That's correct. Yep, we don't. Yeah, so that's why using a more sophisticated method like linear regression is going to give us a better, because it will give us a line very similar to this, similar format with the slope and a y-intercept. But it's going to be a little bit different because you're right, all of those points in between are not going to fall exactly on the line, probably. You know, this is not a perfect relationship. Yep. Check marks in there. Any questions about using the high-low method? Here are the drawings. Go back. Give me 1 second here. I just want to see if where to go next. Yep. Okay. So with the time we have left, we're going to get into CVP, cost volume profit analysis, and what does that mean and how do we use it? And we'll continue with this on Thursday. So CVP, or cost volume profit analysis, is looking at how our selling prices and our costs are associated. If we understand the relationship between our fixed and our variable costs, we know that our variable costs are going to go up if we produce more, go down if we produce fewer units. We know that our fixed costs within that relevant operating range, I just tried to make that 2 words into one, relevant operating range are going to be a constant or predictable number. We can use this, our knowledge about that, to help us with making sure that we're setting our prices, to predict how many units we need to sell to break even, as I said at the beginning of class when we were looking at the learning objectives, that if we're selling multiple products, how many of each product would we need to sell in order to achieve some targeted profit. And so it helps us with managing our business and recognizing what's important and what changes and what stays the same within our financial structure. As I said at the beginning of class, in chapter 5 in financial accounting, we introduced the concept of gross margin. And I will just remind you of what that looked like, because I don't think, give me 1 second here, I don't think I have a diagram that's going to help me in one of the upcoming slides. Nope. Okay, so let me just draw this out for you. In chapter 5 in financial accounting, we introduced the concept of a multi-step income statement, and it looked like this generally. Sales minus cost of goods sold equals gross margin or gross profit minus operating expenses equals net income or operating income. So I'm going to put that, I'm going to draw a couple lines in here. So that was the generic format for a multi-step income statement. We started with our revenues, like any income statement. We subtracted from it cost of goods sold, which are our product costs. And then we found our gross margin. And from that, we subtracted our operating expenses, which we now refer to as period expenses. So at the beginning of chapter 15, or in chapter 15, we talked about product versus period, fixed versus variable, value-added versus non-value-adding expenses. What we're introducing now is, rather than looking at our costs strictly as product versus period costs, we're going to divide them up based on their cost behavior. Are they fixed or are they variable? We've just spent the last exercise going through, well, what if it's mixed? What do we do with that? We are going to be using the high-low method, a very simple approach, to separating those mixed costs into their fixed and variable so that we can do this analysis more effectively. To be clear, what's on the screen right now, this multi-step income statement is what is required under GAAP. That is what you will always see on a company's published financial statements. We divide our costs, product, and period. But for our internal purposes, we are going to divide them now, at this point, based on fixed or variable. And some of our product costs are going to be fixed, like depreciation on the equipment, rent on the factory, or taxes on the factory, or insurance on the factory. And some of the product costs are going to be variable, direct materials and direct labor. By the same token, some of our operating expenses are going to be fixed and some are variable. So we're taking those product and period expenses and dividing them differently. So we take our sales and we start with our sales still like any income statement, but we subtract from that our variable costs, and that gives us this new concept of contribution margin. I'm just abbreviating. Contribution margin. Then we subtract from that our fixed costs and get our operating income. So the bottom line is still the same, operating income. The top line is still the same, sales. But rather than dividing our expenses in total are still going to be the same. But rather than dividing them based on product versus period, we divide them based on fixed versus variable. Okay, so that's what contribution margin is. It's what's left of every of our sales dollars after we cover those variable costs. It's what we have to contribute toward our fixed costs, and once those are covered, we'll start to have operating income or a profit. Let me go to, whoops, I'm gonna have to erase that. I was hoping I could keep that on the screen. So let's go to our next exercise here, which is about contribution margin ratio. And you can see on the screen how we're going to calculate that. So I just explained what contribution margin is. It's sales minus variable cost. And then we divide that by sales to get a percentage. The contribution margin ratio is going to be expressed as a percent. It's what's left of every dollar in sales to contribute toward our fixed costs and eventually to an operating income. So in this example here on the screen, the contribution margin ratio is 40%. That means 40 cents of every sales dollar is left after you cover the variable cost. Let's go to our exercises. And our next exercise is about the contribution margin ratio. Young company budgets sales of 112,000. That's the third time I've done that today. $112,900,000. Fixed costs of 25,000 and variable costs of $66,611,000. What is the contribution margin ratio for young company? So the contribution margin, remember, is sales minus variable costs. That would give us the contribution margin. The contribution margin ratio then takes that number and divides by sales. Anyone get an answer for that?
41%.
Thank you, Seth. 41%. Okay. Everyone okay with where that came from? In part B, we mix things up a little bit. We're told what the contribution margin ratio is and what the sales were and what the fixed costs are, and we're asked to calculate operating income. So if our sales were 34,800,000, you'd think it was a Monday. If the sales were 34,800,000 and the contribution margin ratio is 40%, what is our contribution margin in dollars? It's going to be 40% of the sales, right? So our contribution margin ratio is 40%. That means 40% of the sales is contribution margin. If we think about that relationship, just going to repeat what I had on that previous, on the screen a minute ago. Sales minus variable costs minus fixed costs equals operating income. And I took out the intermediate step of contribution margin. But we know that sales minus variable cost gives us contribution margin. Right? Sales minus variable cost is our contribution margin that we just calculated. Everyone okay with that? And our fixed costs are $1.5 million. So our operating income should be $12,420,000. So that is exercise 5, right? Is that 4 or 5? 5, yeah. With the time we have remaining, we have about 8 minutes left. I want to set us up for what we're going to look at in class on Thursday. Okay, so we're going to not do any more exercises for today, but we're not done with class because I want to take this one step further. I'm just going to do it on the white part of the screen here. Okay. Any questions about what we've done so far? I'm just going to erase those. And I'm going to use the white part of the screen here to set us up for Thursday's class. I am repeating. Oops, sales minus variable cost minus fixed cost equals operating income. Okay. I'm just going to do a little bit of rearranging of this formula. How do we know what our sales are? Well, we take our selling price, I'm going to call that SP, selling price, times the number of units that we sell. As I said at the beginning of class, when we get started with this CVP analysis, we're going to assume that the company produces just one product and they sell it all at one price. And later on in the class on Thursday, we'll get into, okay, but how many companies actually sell just one product? And so we'll look at the concept of a sales mix when they're selling multiple products. We're still not going to overly complicate things. I think we'll look at, I think the situations we'll look at have like 3 products that they sell. But for now, we're just starting with, they make 1 product, okay? 1 product. And so we can find our sales by taking the selling price and multiplying by the number of units. And what we already know, we can find our total variable cost by taking our variable cost per unit and multiplying by the number of units. And just to make this clear, I'm going to group these things together. It's not really necessary because of order of operations, but it'll probably help people. And so what I've done is just expanded that. Sales is selling price times unit. Variable cost is variable cost per unit times units. We saw, though, that our fixed costs aren't determined by the number of units. And so I'm just going to leave that alone. And I'll simplify that. Operating income. I'm going to simplify that. Fixed cost. Okay. So there's just an expansion of that equation that we started with. I'm going to see what I can simplify here. I'm going to factor out the units. So now I have units times the quantity, selling price, minus variable cost per unit. And I'm trying to solve for units. So I'm going to add fixed cost to each side. So I factored out the units. I moved the fixed cost to the other side of the equation. And this is what I have right now. I'm trying to solve for units. So what I'm going to do next is divide both sides by this, what's in the parentheses here, selling price minus variable cost per unit. And this is what we get. Units equals, in the numerator, we have our fixed costs plus our operating income or our profit and then in the denominator, we have selling price minus variable cost per unit. Ready? Okay. So all I did I took the contribution margin income statement, the formula, sales minus variable cost minus fixed cost equals operating income. And I just solved to find the number of units. This formula that I just put here in the red box is the formula that you need for the rest of the chapter. So now you know where the formula comes from. We'll be using this formula on Thursday. I would make a note of that formula. I will tell you that the book introduces this kind of in 2 stages. They make it seem like it's 2 separate formulas in the next couple sections, and it's not. It's just one formula based on the contribution margin income statement. I will also point out to you that what's in the denominator here, selling price minus variable cost per unit, we have a special name for that. What's in the denominator here is the contribution margin per unit. What's in the denominator is the contribution margin per unit. How much is left over of the sales after we cover the variable cost per unit? So if we charge $100 for the product and there are $40 worth of variable cost, the contribution margin is $60 per unit. That's a contribution margin ratio of 60%. So as we run out of time for today, please make a note of that formula. I just showed you where it comes from. So when we start class on Thursday, I will probably put the formula back up on the screen, but I will assume that you have it and you know where it comes from. And then we'll see how we can use it. Any questions as we wrap up for today?
One question on the annual report.
Okay.
I was looking at my company and they looked at articles on different racing events and I didn't really find anything related to the company.
So you may want to choose a different company. So the question in the classroom was, if you're looking for the sources for the annual report project and you aren't finding what you need, what do you do? And the answer is, it's not too late to change companies, and that's exactly why we have this step here where you have to find the sources to make sure you can find them. So if you do want to change companies, what I would ask you to do is just go back to that discussion board where you posted your company originally and just post a new company, make sure someone else hasn't chosen it. And then I'll go in and approve it and I'll update my records where I keep track of who's doing what.
Do you want me to make a couple of weeks ahead or just reply to my-
Doesn't matter. Either one is fine. Any other questions? All right, well, thank you for being here. I'm going to pause the recording.